Poštovani novinari, dame I gospodo,
Ladies and gentlemen, esteemed members of the press,
saradnicima, nismo se videli na
I welcome you all. We haven't seen each other at the two previous inflation report presentations, and we thought that you might find it less interesting to attend the presentation without me. Here we are today in all of us together. The press won't have any dilemma as to how to convey the statements of my associates and their names and titles. They're all here presented visibly, although I'm sure you know them all very well. Once again, welcome to the presentation of the May inflation report. We will give you an overview of the current macroeconomic developments, our new inflation and economic activity projections, as well as monetary policy decisions in the period since the previous report. To begin with, I would like to underline that positive economic trends have continued in 2019. Macroeconomic and financial stability have been preserved. Economic investment and external trade activities have increased, while the share of our country's public debt in GDP has contracted even further. All of this has been achieved despite the adverse effects of some factors from the international environment, notably the slowdown in euro area growth. For 6 years in a row, inflation has been low and stable, and we expect it to remain so in the coming period as well. In accordance with our expectations, inflation has continued to move within the bounds of the target tolerance band of 3 plus minus 1.5% in 2019. In April this year, consumer price growth equaled 3.1% year-on-year, with more than half of the increase attributable to the rise in the prices of vegetables on account of the low base and last year's dampened yield in other parts of Europe as well. Other than that, inflationary pressures remained low on both the cost and supply sides, as attested by the core inflation of 1.4% in April. As announced in February, we expect inflation to slow down during the next 12 months due to the base effect from vegetable prices. We expect it to come close to the target midpoint over the medium term, which will be facilitated by growth in aggregate demand. Briefly put, inflation will remain low and stable within the bounds of the target tolerance band until the end of the projection horizon, that is, over the next 2 years. These are also the expectations of the financial and corporate sectors. Anchored inflation expectations are indicative of monetary policy credibility, which contributes to greater resilience to potential negative effects of developments in the international environment. We'll move on to financial conditions in the domestic market, which have remained favorable. The favorable financial conditions in the domestic market are also evidenced by movements in the loan rates, which dropped to their lowest levels in the dinar segment of the market at the start of the year. The declining interest rates, coupled with the rising economic activity and positive labor market developments, contribute to the increase in lending activity. Although the year-on-year growth in lending is measured in 2 digits, the share of loans in GDP is stable and poses no risk to either price or financial stability. Through our activities, we have bolstered banking sector stability additionally in the prior period, as seen by the share of NPLs in total loans, which declined to 5.5% at end March 2019, which is its lowest level on record. Favorable fiscal trends have been maintained. As in the past 2 years, 2019 has also seen a fiscal surplus, which measured 0.9% of GDP at the consolidated level in Q1, while the central government public debt declined further and equaled 50.9% of GDP at end March. The fiscal policy, in full coordination with the monetary policy, stimulates economic growth without giving rise to inflationary pressures, and growth in the government's capital expenditures contributes to the increase in investments, while rising public sector wages and pensions provide support to sustainable consumption growth. Stable economic growth is driven by investments propped by the improved macroeconomic and financial climate. According to preliminary data of the Serbian Statistical Office, GDP growth in the first quarter this year equaled 2.3% year-on-year. Excluding the seasonal effect, quarterly GDP growth equaled 0.9%, meaning that economic activity has upheld the upward trajectory for 18 consecutive months, though growth in external demand slowed down as of mid-2018. According to our estimate, the achieved GDP growth is attributable to domestic factors. A key contribution to growth came from fixed investments, which posted an essay growth of 7.4% in the first quarter, namely private investment by 8% and government by 4.7%. Serbia's economy has become more attractive to investors, mainly owing to the improved business climate and favorable financial conditions, while the implementation of infrastructure projects has also accelerated. In regard to this, we should note the increased profitability of the economy, which ended the previous year with a net profit of 500 billion dinars. This is an important source of investment and indicates that investment in our economy indeed pays off. Our growth forecast for this year has been retained at 3.5%, and we expect it to pick up to around 4% in the coming years, with growth resting on firm grounds, primarily owing to the preserved macroeconomic stability. Growth sustainability is also confirmed by the greater integration of our economy in global economic flows, both trade and capital, since FDI inflows are on the rise. Although affected by the slack in external demand and steel quotas, the export of goods recorded a 7.9% year-on-year increase in Q1 2019, owing to the expansion of supply on account of early investments and accelerated sale of the surplus of agricultural commodities carried over from 2018. On the other hand, the expansion of output and investment boosted the import of equipment and intermediate goods, and in turn, the overall import of goods by 9.9% year-on-year. At the same time, the inflow of capital in the financial account, largely on account of FDI, of over 1 billion euros since the beginning of the year, covered the current account deficit and brought the FX reserves up. Since most of the FDI inflow went to tradable sectors, in the medium term, we expect a further rise in exports and a gradual narrowing of external imbalance. With external debt on a downward trajectory, this further strengthens the external position of the country. Ladies and gentlemen, dear colleagues, what has previously been said clearly indicates that Serbia's economic agenda continues to yield robust results, reflecting favorably on the credit rating and country risk premium. Let me remind you, at the end of last year, Standard & Poor's upgraded the outlook from stable to positive, while Fitch, in early May, affirmed a stable outlook, citing economic policy continuity aimed at further strengthening of macroeconomic indicators and public debt reduction. Lower risk premium, measured by the EMBI, which almost reached its historical low in early May, also speaks in favor of the previously mentioned fact. And this is also backed up in practice by investments of foreign investors in government securities, as witnessed by this month's successful implementation of 7-year dinar securities auctions. We believe that the good results of our economic program will also be confirmed by the findings of the current IMF mission. The achieved success was facilitated by the adoption of adequate, well-coordinated and timely economic policy measures. Integral to that is the monetary policy, which, through the provision and preservation of price and financial stability, significantly contributed to the sustainable acceleration of economic growth. The fact that the results were achieved amid uncertainties in the international environment only confirms the efficiency of the monetary policy and the measures the MBS takes in order to strengthen the resilience of our economy. In the coming period as well, monetary policy will continue to be predictable and consistent in delivering low and stable inflation in the medium term. As the key risks in the monetary policy pursuit still emanate from the international environment, the National Bank of Serbia will continue to closely monitor and analyze movements in the international financial and commodity markets and assess their impact on economic developments in Serbia. Allow me to conclude by saying that our economic policy has made the economy more vital and capable of addressing the market challenges that we have faced in the past, as well as those that lie ahead. Serbia is now a country where doing business and finding a job is easier, and the living standard is rising on sustainable grounds. Of course, further improvements are still possible, first and foremost by means of structural reforms which will sustain a further rise in investment, competitiveness, profitability and employment. This will enable us to preserve the achieved results and respond to future challenges. And to honor this, the fact that we meet again, I would like to state a data that's not in the speech because we are talking about a preliminary figure, and that's the fact is that at end April, the gross FDI equaled 1.2 billion euros, which means it was up by 14% relative to the same period last year. So this data won't be changed, perhaps in terms of structure, but I can certainly deliver this good news to all who are looking forward to seeing Serbia make further progress. I give floor to Savo Jakovljević to present the details of the inflation report.
Thank you, Governor. We shall now present to you the current and expected economic developments in the domestic and international environment which have motivated monetary policy decisions of the National Bank of Serbia. At the start, I will give a brief overview of developments in the international environment which is still beset with considerable uncertainty and the impact of such environment on emerging economies, Serbia included. Since our presentation in February, the global growth outlook has deteriorated again, notably in the short run. However, recent announcements of leading central banks that the normalization of their monetary policies will be slower, the easing of trade tensions and the latest macroeconomic data suggest that global trends in the coming period could be somewhat more favorable than expected. The growth forecast of the euro area, our key trade partner, was revised down for this year, but Q1 growth surprised on the upside, speeding up to 0.4% from 0.2% and 0.1% in the previous two quarters. Though slightly revised up, the economic growth of countries of our region, which are also our important trade partners, is expected to remain relatively high, led by elevated domestic demand. The inflation outlook has also been revised down in the majority of countries, primarily due to the expected global growth slowdown. A risk associated with global oil prices is present as well. Our projection assumes that euro area inflation will move in accordance with the ECB's projection, that is, below the inflation target in the next 2 years as well. In light of this, the growth in our import prices is likely to remain relatively low. In the context of expected lower global growth and a slower rise in inflation, the Fed announced it would be patient on any future interest rate moves, while the ECB announced a new long-term financing program to be implemented from September 2019 to March 2021, so as to ensure that lending conditions remain favorable. This should positively affect conditions in the international financial market and capital flows towards emerging economies, as well as the stability of their foreign exchange markets. It, however, remains uncertain to what extent the normalization of monetary policies of leading central banks will be slower and different from market expectations, which mandates caution, since this could trigger sudden changes in global capital flows. Uncertainty as to future movements in the international environment is also associated with global primary commodity prices. Also uncertain is the movement in global oil prices, which since the start of the year went up by around 30% to around $70 per barrel, reflecting the cap on production of leading world exporters and geopolitical tensions. However, market participants do not expect any significant oil price hikes in the coming period. Moreover, according to futures, oil prices are likely to stay at the current level by late this year and to be somewhat lower in the next 2 years. As suggested by futures, no significant changes in global primary agricultural commodity prices are expected either. In contrast to uncertainties in the international environment, the domestic macroeconomic conditions of monetary policy conduct remain favorable. Q1 saw a fiscal surplus of 11.2 billion dinars against the backdrop of much higher government capital expenditure and increased outlays for wages and pensions owing to economic growth and rising employment and wages. At the same time, the share of public debt in GDP fell to 50.9% at end March, and its downward trajectory is expected in the coming period as well. The share of external debt in GDP is also declining, which, along with the high FDI inflow, contributes to the sustainability of the country's external position. FDI still largely covers the current account deficit, which has been, since the start of the year, under the impact of rising investment and dented external demand, as well as 100% tariffs on products delivered to Kosovo and Metohija. Goods imports rose somewhat faster than exports owing to the continuation of the investment cycle. Despite the slowdown in external demand, exports growth remained relatively high thanks to new production capacities and the exports of agricultural inventories from last year. The current account deficit is estimated at around 5% of GDP this year. It is expected to narrow further down in the medium run on the back of earlier investment in tradable sectors. The net FDI inflow is assessed to be stable in the coming years at the level of around 5% of GDP and will be, as so far, more than sufficient to cover the current account deficit. The improved internal and external position of the country, along with sustainable economic growth, is the basis for further improvements of our country's outlook. This is confirmed by the low-risk premium and a more favorable credit rating of the country, which strengthens Serbia's resilience. Following moderate depreciation pressures in January, appreciation pressures, which marked the past 2 years as well, have re-emerged as of February. To mitigate excessive short-term volatility of the dinar against the euro, since the start of the year, the National Bank of Serbia has intervened by buying 110 million net, thus pushing up the country's foreign exchange reserves. The National Bank of Serbia's key policy rate is at its lowest level in the inflation targeting regime, 3%, which reflects positively on the terms of financing of the private sector and government. Interest rates on dinar loans dropped to new lows, which, coupled with the rising economic activity, wages and employment, led to a stable growth in lending of 10.1% year-on-year in March, excluding the exchange rate effect. If the effects of NPL write-off and assignment are excluded from the calculation, lending growth is even stronger, measuring 12.2% year-on-year. Economic activity continued up for the 18th consecutive quarter, with Q1 2019 witnessing growth in all key sectors except for agriculture due to the high base effect. The greatest contributor to Q1 growth was the rebound in industrial production, which had been affected by the euro area slowdown for most of 2018. Still, the effect of weaker external demand on industrial production remains visible. Together with the base effect in agriculture, it led to the 2.3% year-on-year GDP growth in Q1, as estimated by the Serbian Statistical Office. We kept the GDP growth forecast for 2019 at 3.5%, with a slight change in the growth structure. Same as in the previous projection, GDP is expected to be fully led by domestic demand, which is likely to enjoy higher growth thanks to more favorable trends in final consumption and especially investment since the start of the year. On the other hand, due to the slower growth in the euro area, the negative contribution of net exports should be somewhat higher compared to the previous projection. GDP growth is expected to pick up in the medium term to around 4%, led by investment, exports and household consumption rising on sustainable grounds. Inflation continued to move within the bounds of the target, 3 ± 1.5%, and consistent with our announcements, gradually approached the target midpoint since the start of the year. It should be noted that more than half of the April's inflation of 3.1% year-on-year was triggered by the rise in vegetable prices. On the other hand, core inflation remained low, moving between 1.2 and 1.4% year-on-year since the beginning of the year. Under our May central projection 2, year-on-year inflation is expected to continue moving within the target band until the end of the projection horizon, most likely in its lower part. After reaching the target midpoint in April, inflation will turn downward, only to approach the lower bound of the target in the first half of the next year, and then to embark on a gradual return toward the target midpoint. Same as in the previous projection, the inflation factor expected to play the key role throughout the projection period is the growth in aggregate demand. Besides, the disinflationary pressures on account of the past appreciation of the dinar should gradually wane, while administered prices are expected to pick up somewhat faster than in previous years. High base for vegetable prices will also put a downward pressure on inflation in the coming period. Uncertainty surrounding the inflation projection relates primarily to movements in the international commodity and financial markets and, to an extent, administered price growth. Overall, the risks to the inflation projection are judged to be symmetric, that is, balanced. In the closing of my today's presentation, I would like to draw your attention to the 4 text boxes of the May inflation report. I would now like to present to you 4 text boxes which cover topical issues. The public has been interested in slower developments in the euro area and the impact of these developments on our economic activity. Our colleague Mirjana Miletić, the head of the Analytical Reporting Division, will present what her colleagues have investigated and presented in a text box. We have also examined the movements in the market of agricultural and food products in Serbia, and one of the text boxes is also dedicated to that. After that, Milan Trajković will tell you something about the dynamics of savings and investment balance over a longer period, which has also attracted interest from the expert public. And after that, Nicola will tell you something more about our additional FX swap auctions and about the additional instruments that we use in order to spur economic growth and ensure a smooth functioning of the FX market.
Thank you, Madam Governor. One of the text boxes that we have prepared for this inflation report concerns the extent of synchronization of economic and financial cycles with those in the euro area, given the financial and trade links of our country with the euro area. The main analysis concerns the impact and the monitoring of the link of the cyclical component of economic and credit activity in Serbia with the euro area. And the most important results, in short, are the following. So there is a degree of harmonization. In terms of credit activity, it equals around 0.6, and in terms of economic activity, it is also close to this level. Another important fact to emphasize is that the phase of the deceleration for the period from 2004 onwards, for which the analysis has been made, indicates that on average the deceleration phase lasts for around 4 quarters and the expansion phase lasts for around 8 quarters. Given that the euro area is in the deceleration phase since the second half of last year, this has impacted the deceleration of economic activity in Serbia. But given that this phase lasts for around 4 quarters, starting from the third quarter this year, we can expect a significant deceleration of economic activity in Serbia as well, which that is acceleration, not deceleration, which also speaks in favor of the fact why we adhere to our projection of 3.5% growth for this year. A similar thing applies to the credit cycle, given that the ECB announced that the pace of normalization of its monetary policy will be slower in the coming period, so we can still expect positive effects on domestic credit activity in the coming period. When it comes to the second text box relating to the agro industry, we have also prepared several slides for you here. First of all, we have analyzed the exports of the agro industry, that is the exports of agricultural and food products over a longer term. So what you can see on the left chart in this slide is that the exports of the agro industry, that is the share of the exports in gross value added, increased from around 32.7% in 2005 to around 70% in 2017, which actually means that the exports of our products are rising in foreign markets, which confirms the competitiveness both in terms of price and quality. This is also confirmed by the fact that we have seen an increase in exports of the agro industry at a global level, as you can see in the left chart. So they rose from around 0.16% in 2005 to 0.27% in 2017. So the fact that we have seen a rise in exports of industrial food products speaks about the fact that we are exporting the products of higher phases of processing to foreign markets. If we take a closer look at the impact of exports of the agro industry on foreign trade trends, as you can see on the next slide, we can see that exports rose at a higher rate than imports. If we compare the exports and imports, the average annual exports growth rate was around 11.1%, and of imports 8.1%, and year after year, we have seen a rise in the surplus of foreign trade on these grounds. And in 2018, the commodity surplus of the agri-industry equaled 1.1 billion euros. In terms of the groups of products that contributed the most to the surplus, we can say that we have here cereals, cereal-based products as well. Beverages, fruit and vegetables, vegetable fats and oils, tobacco products, products made of sugar. What is also important to emphasize is that we have seen an increase in the exports base, owing to which in the coming period on these grounds we can expect further improvement of our foreign trade position. And just to conclude, the agro-industry in the previous period gave a positive contribution to the balance of payments and economic activity of our country, and given the potential that it has, we can expect its positive contribution to sustainable economic growth that is a contribution to growth that is largely led by investment and exports. Now I would like to pass the floor to my colleague Milan Trajkovic, who will say something more about the text box on the balance of savings and investment.
Given that the current account deficit in previous years was frequently talked about in the expert public, we thought it important to analyze it now in terms of factors, which is the investment and savings balance. It's important to note that before the crisis in 2008, the current account deficit in Serbia, actually the negative gap between savings and investment was 20%. In response to the fact that capital flows were directed mostly to consumption and not investment. So during the crisis in 2009 and 10, the gap narrowed considerably, but in 2012 it broadened again to 11% of GDP, mostly in response to unsustainable fiscal policy and the fiscal deficit, which exceeded 6% of GDP in 2012. Owing to fiscal consolidation, we had, since 2013 onwards, we had a considerable narrowing of external imbalances. So gross national savings rose with investments as well, and their share in 2016 was estimated between 20.5% and 21%. It's also important to note that the current account deficit of Serbia in 2017 and 18 was determined by investment, whose growth was 7.3 in 2017 and then 9.2 in 2018, and this resulted in a rise in equipment of 400 million euros in both of these years. When we analyzed the investment and savings balance in terms of the public and private sector, government and private sector, since 2017, the government gave a positive contribution to the reduction in the external imbalance owing to the budget surplus it has been posting, while the current deficit on the whole is dependent on moves in the private sector, which we expect to continue in the coming period, bearing in mind the fiscal policy and all of our other expectations in terms of macroeconomic indicators. I would like to conclude here and invite you to look up more details in the text box 3, where we presented this topic.
Thank you, Madam Governor. I would like to start with something that the Governor emphasized at the very start. So in the previous period, we adopted adequate and timely monetary policy decisions. The National Bank of Serbia does not wait for anything to happen. It acts preemptively. The proof of this are additional FX swap auctions organized since late January this year with the aim of balancing, that is, further rebalancing of the liquidity situation in the banking sector. In early year, we saw a reduction in surplus liquidity in the banking sector, and the central bank, so as to prevent a sudden increase in interest rates, which did not happen, it responded proactively by thinking in advance and by using additional swap auctions. That is, it organized an auction at which, in the first leg of the swap, it boosted the bank liquidity by 22.5 billion. That is, it withdrew a certain quantity of euros from the banking system. So what was achieved with these auctions is that short-term interest rates were cut by around 50 basis points. That is half of the percentage point. So we can emphasize that overnight Bonia stood at 2.5% before the auction. That is, after the first auction, we saw immediate positive results. It was cut by 2%, and it stands here at this level right now as well. In the past several months, it ranges between 1.8% and 2%. So, in addition, the central bank has demonstrated flexibility in the conduct of its monetary policy. That is, without changing its key policy rate, it can ease the conditions of monetary policy conduct, so it can trigger a reduction and maintenance of interest rates at a low level. And as the governor emphasized as well, this translates into the real sector. So we have real rates on dinar loans that are at their historical lows. We have also seen that the central bank follows all developments, conditions in the interbank market, and it will respond when needed and timely in order to preclude any jeopardy of the stability of the money and FX markets. We have also proven that we can respond in time, that is proactively, and we emphasize this once again. So we can also use the regular instrument that we have at our disposal, that is the monetary policy instrument, and the banks will not get used to the central bank of giving them aid whenever they need. So, namely, banks have to reorient themselves to the interbank market, that is to each other, and the National Bank of Serbia will respond at any moment if there is a need to do so.
The balancing of interest rates and not allowing them to rise means maintaining the cost of borrowing for the corporates and for the household sector. And this is the reason why we are reacting in such a timely manner. Now we would be happy to take any of your questions relating to the inflation report. We don't want our colleagues dealing with inflation projections to feel neglected. I always tend to say that behind inflation projections we have real people, because people give inputs for those projections. And then my colleagues sometimes feel neglected because we give preference to them and not to the models that they produce. And I was pleasantly surprised by them when, for the previous executive board meeting, they prepared an analysis upon the model of the best regulated central banks. So they produced a yield curve model, which means a lot to us, especially to our colleagues in the Foreign Exchange Reserves Management Department. And I wanted to use this opportunity to commend them publicly, because this model will be used for producing the forecasts of dinar yield curves. And this is something that will be applied in the implementation of Solvency II directive. Now you can ask him questions regarding the inflation outlook. Please, the floor is yours. Since you said that you have maintained your growth forecast at 3.5% for this year, how much should growth, what should be the growth figure in the next 3 quarters in order to have that amount at the annual level? Since Milan defended our projection before the IMF mission staff, I give the floor to him now. Thank you for your question. I will first briefly comment on the 2.3% growth in Q1, and we'll give our growth projection for the next 3 quarters, and we'll then give you the answer relating to your question regarding the European Commission. First, when it comes to the 2.3% growth in the first quarter, what we would like to highlight is that given all the problems faced by the Serbian economy late last year and early this year, for us, this was a positive surprise. Growth surprised us, and our first estimates for Q1 were 1.5% and then 1.8%. We're talking about a simultaneous shock faced by the Serbian economy when it comes to the slowing of external demand and the imposition of 100% tariffs. So having all this in mind, this is an excellent result. Seasonally adjusted, it measures 0.9% and is even faster than the growth recorded in the third and the fourth quarter last year. Why did this happen? First, we had better results of manufacturing in February. Then we had a much better production in the sectors of energy and mining in March, and a much faster investment growth and a much faster rise in activity in the construction industry. With relatively high certainty, we can say that growth in the second quarter will accelerate to 3 to 3.5%, and given the activation of a number of investments in manufacturing industry, then the opening of highways and the intensification of works, which can be expected in the second half of the year, it is reasonable to expect growth between 4 and 4.5% in the second half of the year. This is why we have maintained our growth projection, and also the risk balance has remained unchanged. We have not revised the risks. If you take a look at the European Commission's report, you can see that they have revised the projection for one reason only, and this is because of their view of our exports. Exports have been revised to 7.5% to 6%. We do not share their view, and our data for the first quarter are supportive of our view. We have had growth in the services sectors, even in these conditions, and this growth measured 10.4% and exceeded the figure that we expect for the year as a whole. And this growth is due to slower demand from the euro area. If you take a look at the European Commission's report, you will see that they say this is due to the slower euro area growth. Milan, do you want to say anything about the seal quotas? For the time being, we have not been affected that much by the seal quotas. In the first quarter, we had an increase in seal production in the first quarter, think by around 500,000 tons. But these import quotas have been designed in such a way that they do present a risk. Determining the quotas 15 to 18 is not really convenient for us, since given all the investments in the Smederevo steel plant, we have had an increase in production and exports in the Smederevo steel plant, and this growth was not included. This narrows our scope for using these quotas. But the quotas will not affect us that much. We do not complain. We'll do everything we can in order to eliminate the impact of 100% tariffs, and the synchronization of the euro area and Serbia in terms of economic and credit activity cycles. This is something that will guide us in our pursuit of policy, and we will do everything in order to support the economic policy of the government in order to eliminate the negative effect of external factors. This is something that cannot be predicted fully. We have talked about the price of oil, about agricultural products, about meat prices on global level, but it is up to us to adjust and to react proactively and responsibly. I only wanted to add that Serbia is trying to forge its own way. We are listening to everything, we are doing projections, we are carrying out analysis, while other central banks are embarking on key policy rate hikes. Some of them are maintaining key policy rates at unchanged levels. Some of them are facing instability of their currencies. For instance, the Czech Republic is faced with a dramatically low value of its own currency, and looking for one's own way is forging one's own path requires great responsibility, and this is something we have already demonstrated. I will share my pleasure with you at the news that NCR is opening a new technological park, and this is something we heard yesterday. The National Bank of Serbia, of course, will support these trends by commending and encouraging the agro-industry. At the same time, we are also supportive of the application of the latest and state-of-the-art technology, and I hope that we will meet soon on an occasion that will be to the benefit of all engaged in the production of software and opening of new jobs in this area. Are there any other questions?
If there are no more questions, thank you very much and see you soon.